Welcome to this explainer. Today, we're unpacking one of the most fascinating and frankly concerning financial events on the horizon, the impending SpaceX initial public offering. Now, on the surface, sure, it's a story about rockets and space exploration, but when you really dig into the data, there are some deeply hidden mechanics at play here. We're going to uncover exactly how this IPO is being structured, and more importantly, how your very own retirement account might unknowingly be footing the entire bill. So Elon Musk is currently prepping SpaceX for what is gearing up to be the absolute largest IPO in human history. They're targeting an astronomical valuation of $1.75 trillion. Just let that number sink in for a second. $1.75 trillion. At that price tag, SpaceX wouldn't just be a huge company. It'd be worth more than every major American defense contractor combined. It's a monumental figure that just totally shatters traditional market expectations. To put that staggering number into everyday perspective, we aren't just talking about beating out other aerospace companies here. This valuation would make SpaceX worth more than Coca-Cola, Disney, Nike, and Starbucks, all put together. Think about that global footprint. Every Coke consumed, every Disney ticket sold, every pair of Nikes, every single cup of Starbucks coffee worldwide. SpaceX is aiming to be valued higher than the whole shebang.
But this brings up a pretty terrifying question, right? Especially when you start digging into the company's actual financials. Who exactly is buying into a company that is currently bleeding cash, yet debuting at the highest valuation in the history of the stock market? Normally, a price tag this high is reserved for companies generating massive, stable profits. So where is the cash actually going to come from to support a trillion-dollar valuation?
Well, the shocking answer is you are. Within a few weeks of this IPO, your retirement account, your 401k, or your pension fund is going to become one of the biggest buyers of this stock. And the kicker here? This is going to happen whether you like it or not, and whether you've researched the company or not. It all comes down to the automated mechanics of our modern financial system, which we're going to break down step by step.
Section 1. Deconstructing the SpaceX empire.
To understand how this trap works, we really need to peel back the layers. You see, SpaceX isn't just one single rocket company. Behind the scenes, it's actually three completely different businesses stacked on top of each other, wrapped up in one corporate package. While the iconic rocket launches get all the media attention and the viral videos, they actually only represent 25% of the company's revenue. The real financial engine here is the satellite internet giant Starlink, bringing in over 60% of their total revenue. Basically, the rockets are the marketing, the satellites are the actual business.
And you see a really stark contrast between these different arms of the empire. On one side, you've got Starlink. This is the crown jewel. It practically prints cash with over 10 million subscribers and profit margins topping 60%. It's a highly successful business. But on the exact opposite side, you have xAI. This is a recently absorbed artificial intelligence lab, and it is a literal cash furnace. We're talking burning through roughly $1 billion a month. And to make matters worse, by early 2026, all 11 of its original co-founders had completely walked out the door. So SpaceX essentially paid billions for an AI company that needs to be completely rebuilt from scratch.
So here is the crucial point. You have to look at the consolidated math. When you mix Starlink's impressive profits with xAI's staggering billion-a-month cash burn, the consolidated SpaceX entity, which is the exact entity going public, actually lost nearly $5 billion last year.
Section 2. The rigged NASDAQ rules. So how exactly does a company that is actively losing $5 billion a year justify a $1.75 trillion valuation? Well, the answer isn't in their products. It's actually found in the rulebook of the stock exchange itself. Just months before this planned IPO, the NASDAQ quietly rolled out something called the Fast Entry Rule. Under the old rules, a newly public company had to wait 3 months before joining major indexes like the NASDAQ 100, and that buffer is incredibly important because it gives the free market time to figure out the fair price of a stock based on real performance. But this new Fast Entry Rule, it slashes that traditional waiting period down to a mere 15 trading days. It essentially rips away the market's ability to undergo any natural price discovery.
Furthermore, they completely removed the long-standing requirement for a company to have at least 10% of its shares available to the public. SpaceX is reportedly only releasing about 4 to 5% of its shares. And here is where it gets truly wild. They added a hidden weight multiplier. This multiplier literally forces index funds to buy up to 3 times more shares than what's actually available on the open market. When you have an artificial rule mandating that funds buy more shares than even exist, you manufacture an immense, totally artificial spike in demand.
Section 3. The exit liquidity trap.
All these customized rule changes, the shortened wait time, lowered public availability, that hidden multiplier, they work together to create a massive wall of manufactured demand. And this leads us to the absolute most dangerous part of this entire setup for you and me. Here's how this automated buy-in plays out. The very second SpaceX goes public, those newly written NASDAQ fast entry rules are triggered. Because SpaceX will instantly be added to major indexes, all those passive index funds and ETFs, the exact same ones sitting in everyday 401ks, are legally bound to automatically buy billions of dollars of this stock. They don't care about the $5 billion loss, they don't care about the XAI cash burn, the computer just blindly executes the buy order.
And this specific dynamic turns retail investors into what the financial world calls exit liquidity. This is a term you absolutely need to know. It's when everyday retail investors are systematically forced to absorb the financial risk of a highly priced asset, providing the actual cash necessary for early insiders, founders, and venture capitalists to sell their shares at the absolute peak valuation. You, the retail investor, end up absorbing the massive risks of a cash-burning company without a choice, a vote, or any say in the matter, simply because your index fund did the buying for you.
As Wall Street insiders so bluntly put it behind closed doors, your 401k is the exit liquidity. The whole system is perfectly designed so that artificial demand spikes the price on day 15, the insiders happily cash out their shares into that giant wave of automated buying, and everyday workers are left holding a highly volatile stock in their retirement portfolios, ultimately footing the bill for the early investors' massive payouts.
You know, passive investing was originally sold to all of us as this incredibly safe, set-it-and-forget-it strategy. Broad diversification, low fees, peace of mind. But as we've seen in this explainer, those exact automated mechanics can be completely exploited. If the rules of the index can be changed to guarantee a buyer for overvalued cash-burning companies, it leaves us with one final, very provocative thought to ponder. If passive investing forces you to blindly buy whatever Wall Street squeezes into the index, what else is Wall Street currently hiding in your retirement portfolio? Keep asking questions, keep looking at the data, and we'll see you in the next explainer.